in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast number 201. This edition of the Moving Iron Podcast is brought to you by TractorZoom, delivering insights. And I have Rich Posson on here. And Rich is kind enough to come on from time to time, about once a month, to talk about what's going on in the economy. And since it's the end of the year, I thought, you know what, Rich, it'd be a great time for you to come on and talk about kind of your recap of 20 and then what you see happening in 21. So first off, Merry Christmas, Happy New Year. How you been? Have a good holiday season so far?
Yes, thank you, and the same to you. I hope you had a good one.
Yeah, we had. My kids got a bunch of stuff they probably didn't need, but that's Christmas, right? That's how it's supposed to work.
Sports economy.
That's right. That's right. Spread the holiday cheer, right? All right, Rich. So let's talk about, 20 was a crazy year. We had all kinds of stuff happen. We've had, the coronavirus put a big kink in a lot of different things. We saw corn get down to $3, and it teetered on the point of getting down to $2.99 a couple of days, but didn't quite make it there. We saw a nice rebound back up to where we see commodity prices now. Take a look at the March 21 contract. I haven't looked at the close here yet today, but when I saw it last, it was like 466.5 or something like that. So it's come a long ways from where it was in March and April, in that June timeframe. So I guess as you take a look at all the stuff that's going on here in 20, kind of what's your kind of synopsis of what you saw happen with some of your models and what of that stuff came out and said, hey, you know what, this is what I thought was going to happen. And you know what, there's some kinks there that I didn't see coming my way.
Right. At the end of every year, I do what I call the annual checkup and try to reevaluate the models, see how close they were, see if there's anything to learn. Was there mistakes and this and that? And in recent years, there really hasn't been much more to learn. It's just like the model has been autopilot. It's been accurate enough. As soon as I try to tweak something to make a difference, so we could have skipped a mistake and done something right, it's like you just get more mistakes popping up. So it's like you can only get so accurate. It's, nobody's 100%, but it's amazing how accurate you can get. I mean, there's some people out there run 70, 90% accuracy. Fascinating thing is I know people only run 50 or 60% accuracy and they make more money. So accuracy isn't everything when it comes down to the dollar, but when it comes to overall business and the way we look at things, we like to see a good accuracy. For 2020, I was very pleased on the economy because I finally got the recession. We started forecasting in 2018 that we got to look for a U.S. recession in 2018 to 2020. And I even said for the global economies as well. And in 2018, you could see evidence of deteriorating global economies, and it got rather severe in 2019, and then just plain plummeted for some economic indicators in 2020 because of the virus. If we hadn't had the virus, obviously it would not have been such a severe recession. The U.S. kind of flip-flopped a lot from 2018 to 2019. We thought we were on our way for a recession, then suddenly it would rebound. The Federal Reserve would come in and interfere, pump some more money, and it would rebound on some indicator, yet you'd have another indicator still deteriorating. And it really came down to the final wire because the model had been saying for many years, even as far back as 2009, the model was saying 2020 is your latest year for a recession, that the economy should peak out, and therefore the stock market, commodities, many other markets, you should have a problem. And we got it. We got the recession. We got a more severe recession than I saw coming. That doesn't bother me. There's nothing to learn there from that. All it does is make the model more right because we were looking for a recession and there was right time for it. It turned out to be a bloody recession because such a severe virus. It was more of a man-made recession, and I'm perfectly willing to even call it a depression now. I know Ben Bernanke over at, when he used to be with the Fed, many of his ideas kind of related to what I was doing in model research on these depressions, recessions. He always thought that, hey, if you have a depression the last 10 years, you just get too many stops, starts. It's a real struggle to get things back to work again. And so his thoughts here during 2020 was this is not a depression. But when you see what our unemployment was, what's happened to some of the lower middle class and the poor and this and that, there's just measurements out there saying, wow, we haven't seen that, for decades. It does go back to the ages of the 1800s, early 1900s of depressions. I think we've seen a new type of depression, frankly. But fortunately, we've had enough faith in the money printing to get out there and still try to hang on to our jobs, do business, consume, spend money, invest, and it has pulled us back faster than what we've seen in a lot of recessions and depressions. It was a significant turnaround for at least the stock market, of course, but for probably half the economy, it was a very fast turnaround. The other half, not so fast. We do have a K-structured economy, okay? And there's one part of the economy is moving up and one part's been moving down. I think the part that's moving down is hitting a bottom. I like the stimulus package that was just recently signed here. They may have to do more in early next year, but my guess is by late next year, we're going to learn we've made it, we survived it, we don't need to do more. And we're all going to get on the same page eventually here, and that's going to be the best growing economy. So here we have an analysis that basically says the economy grows for 7 to 12 years. You have a recession for 1 to 3 years. Recessions, the true recession within that 1 to 3 years may only last 5-6 months. And in the stock market, apparently only last 2 months, which was record setting. But again, you had some fuzzy things going on there with all the money printing, right? Changed things compared to prior generations. With that pattern, we could see that pattern's work going back 150, 200 years, basically the history for this country. And it just looks like it's worked again. We've seen it. I call that the major long-term business cycle. And we're set now for 7 to 12 years of growth, in my opinion. And I don't have a clear picture how good it's going to be. But as I look out over the next 4 years, I think we'll see GDP average 3.5% to 4.5%. That's going to be better. That's almost double what we've seen in the recent 4 years. That's probably getting back towards early Obama years and maybe a portion of George W. Bush's years. So you can see there's structure there to give us a nice GDP. Now, some people say, well, I'm too low. Well, I'm talking what I think can average for the whole 4 years. Within that, I don't doubt we're going to see 5 to 6%, say, for a single year, or some kind of estimate during the year gets that high. And I want to say that we could see that best GDP, the highest GDP up in the 5 to 6% area, actually occur next year. The only thing that worries me is being too bold. I don't want to be overconfident of that. I want to be too bold about that. I see a possibility the first year of any president that just got elected and comes in for the first time, he's got to get his show together. He's got to get his act together. He's got to get his people. And so you really don't see a lot of the programs kick into like the second year or later. And so I could see how this virus and stuff lingers on, that it's still a struggle in 2021, but the economy will still grow. I still think I'll do at least 3% anyways. And then we'll get that 5 to 6% maybe in the second year, third year, and we'll still average 3.5%, 4.5% over the 4 years. But I see a moment of maybe optimism that we'll get a sudden surge in 2021, that GDP just really jumps right up there right off the bat and then tapers off for the remaining 4 years. So that's kind of my scenario, to be optimistic of the economy here, even though, we're still fighting the virus. And as far as my virus model, months ago, I made a comment, I think it was September. I said, okay, it's bottomed. We've got an up move, and it's probably going to top out for virus cases around Thanksgiving to the week of December 18th and no later. Well, believe it or not, on the coronavirusbellcurve.com website tonight, I noticed their highest number of cases was on December 18th. So not only got the week, but I didn't realize it would actually be the day. Now, that doesn't mean there won't be higher cases later. My problem is the model's kind of stuck in the middle here. It's kind of saying, well, that top could occur in November. the higher high by December 18th means we're going to have even more cases in January. And hey, it is wintertime. It's a cold-based virus. In other words, it performs better then. So we could still have serious problems here in the next 30, 45 days of rising cases. But there's also that possibility, maybe this thing's going to calm down for the next month or two. And I don't know how to deal with it. I mean, if we see cases suddenly just drop to 150,000 per day, we probably got the top on December 18th for a while, and we'll just be praying, hey, it's all over long term, that we've got it done. Obviously, if it goes above that December 18 high, we know it's a brand new trend, and then we got to be cautious. Is it going to be a runaway trend, another wave higher of more cases? As I look at the stock market, the economy, the commodities, I'm not so sure that concern over these viruses. They didn't like the news that we got a new version of it, a second version of COVID. But there's still much to learn about it. And it's showing up. And what was I reading tonight? It just showed up, in India. So we had the UK, then it went to France. I probably missed a couple other countries there, but at least tonight I heard it. They just found it in India as well. So, we got to be mindful that something could set this off again. But overall, I like what I see on the economy side here, that I think we're going to have a good economy in 2021. Now, I've been asked about some big names out there in Wall Street and banking communities and whatnot. They were saying we're on the verge of a 1920s. And the 1920s was when middle class were able to get a little taste of what the rich were doing. They were able to invest in the stock market. They were able to leverage their stock market investments. They made a lot of money, some of them. Some of them really didn't accomplish much of anything. But it was generally good business and kind of a happy time for the country. And granted, with the amount of money printing going on here, we start knocking out 5 or 6% GDP. You get that inflation to stay above 2% for a while, and unless interest rates just scream higher, which would spoil the party, then I would say as long as interest rates rise somewhat, I'm happy with it. I think that's actually a good sign, not a bad sign. But I don't want interest rates to explode either. So right. that would shoot us in the foot. But it looks like we have the ingredients here that, for all I know, yes, this could be a very good decade. No matter which political party is running the show, I can just see the overall structure of the consumers and businesses that and the amount of money that's been printed out there, we could make this move. And so, again, I got a positive outlook here on the economy, and for quite some time, there's going to be twists and turns along the way. Hopefully, I can catch some of those and be of some value along the way. But I'm pretty confident of how this model has worked for the history of this country, and going to stay with it, and here's hoping for still better days. Now, that's the economic picture. What does the economic picture relate to, like stock market and commodities? I'll do the stock market first, I think, because the commodities, we can also get into some weather stuff. But on the stock market, fantastic performance this year. Most of it was just because of fantastic reset, meaning I have a signal that only occurs once a decade. And basically, I just dump everything I get out of all my stock investments. And I was just fortunate to get out near the top in February, crashed, bought it 2 days after the bottom, and I didn't know for sure it was a long-term bottom. I just said, this is the first opportunity. It could be we could have several for a year before we work our way out of this mess. But the point is, this is a good price. This is the first signal. Got to take it, see what happens. And lo and behold, market went to a new record high, which proves, hey, that business cycle is right. You got your recession. You got your collapse. Now, brand new bull market. It's over and done with. And stock market can lead the economy by 6 months, and the economy can lead by several months compared to some of the middle class and poor, by the way, which is why I think by late 2021, we'll see that lower side of that K, the other foot that's dropped off here hasn't got back onto the stage. They're going to get there. We'll get everybody on the same page in late 2021. So for me, the stock market, it's today, it seems to correlate better with that 7 to 12-year growth phase and the 1 to 3 year recession than it did like 100 and some years ago. And quite often you hear people saying, I hate the stock market. I can't figure it out. It has nothing to do with fundamentals. It has nothing to do with economy. Well, on a short-term basis, I think that's more true than ever. I get it. And fortunately, I've designed my models to deal with that so I can make money short-term as well and stay with them. But on that specific kind of long-term basis, I see a better correlation today than not in terms of the duration of the trend. How long does that bull market last, which is basically about a decade, and the direction, okay, and the percent return. It's in line better than ever. And the reason is, I think the marketplace has better data than ever before, has a better understanding how the economies work. And somehow long-term, it's able to keep that correlation going perhaps better than ever. Even though on a short-term basis, sometimes it looks confusing. Why are they doing that? They're doing opposite of what all the statistics and the modeling would say. And fortunately, my model's been able to keep up with that, though, saying, okay, it's time for them to head the other direction. They shouldn't be doing it, but they're going to do it anyways, and they're going to get away with it. So it's been very helpful short term. So what I've done is I took a look at history politically. And since 1980, I learned that when a Democrat, when you have a president that's a Democrat, during that 4-year period, any 4-year period, really the return's been like double of that of Republicans. Now, that doesn't mean the Republicans didn't have good times. It just means it was a wider range. The Republicans had some negative times when 4 years ended with a net loss in the stock market. And that usually coincided with recessions. Bear markets had coincided with that downside of that major long-term cycle. So they just happened to show up at the wrong time on the wrong side of that cycle. Whereas the Democrats were fortunate to be on the good side of the cycle. But it was fascinating. I think the Republican side averaged 23% return over 4 years for all the 4-year periods going back to 1980. And yet the Democrats were like 72% or something like that. I think the Republicans are closer to 30% now. I think about 30% and 72%. Big difference. This time around, what I'm going to do come the end of January, I'm going to take the closing price, the S&P 500 in January. I'm going to add 53% to it, and that's going to be my minimum target for the upside in the stock market over the next 4 years, with the assumption that history can repeat. Now, nobody knows and never knows for sure history can repeat. It usually rhymes, as Mark Twain once said. So, maybe we get a new statistic and it won't be that good. But is it going to be like 0 or minus or 10 or 20? Well, unless we get 5 more of these pandemics or an asteroid hits the world, I would say no. There's a good chance it's going to be a positive return over the next 4 years. And but maybe it can be a new statistic and not as strong. But it could be the best under the Democrats was 81% over 4 years. It's pretty impressive. So that all fits with my structure. And again, that's only a specific kind of statistic. It doesn't get into the economy fundamentals. It's just an observation. But as I look at it, it looks like those better times for both Republicans and Democrats, you got a better stock market when you were coming up out of a recession. And especially if we printed money to help pull us up out of the recession. Well, we did all those things, which brings us to the dollar. The dollar's going.
Question. Yeah.
Well, the dollar, of course, it's been down all year, basically. It's had a very nice decline. Well, the other thing is I've seen a lot of discussions of people watching the Swiss franc and the Vietnam currency and a few others versus the dollar, and they're getting all shook up about some of the things that are going on. So then I said, well, most of the time I only look at the dollar index itself, but I went through and looked through like 20 different currencies. And I said, something, back in 2009, when we were pulling up out of the recession from 2009 to 2011, the dollar was basically lower, or at least stable. And against those currencies, you could see those currencies moving higher. And I said, I think that's got some function to go with this business cycle. And here we're repeating the same thing. It's not as volatile. It's not as crazy, but the particular cyclical downturn we just recently saw in the recession was not as important in theory as the super cycles back in 2008, 2009. So I'm saying, okay, so the dollar isn't dropping as fast as it did back then, but so what? It's got the same direction, same timing relative to how our economy is progressing. I think this is a positive sign. Yes, we are working our way out of recession, but I also think it means we got a little more time going down for the dollar. And so some of these banks like Citi saying 20% drop in 2021 or something like that,
Right.
I still think they're overreacting a bit. I won't rule it out. It's now on my table, on my desk. I'll consider it. I think we're on the way to 88 to 85. I think we're going to see 88 here very soon. in the index. I do see the dollar index popping up by February. And February is going to be a funny time. I think we're going to see maybe some problems in commodities, the stock market, interest rates but the bond market may pop up a bit. Interest rates would drop then. And that could be a sign that, we got some bad news coming by February, but I think, frankly, it's just going to be another buy opportunity in the stock market. I don't think the commodities are going to fall apart much at all, but there could be some kind of hiccup coming here in February, and we may see the dollar pop a little, which might bring down the commodities. But for 2021, my guess is we still got lower dollar coming. I'm still a long-term bear. I think the machine, if you will, is basically repeating just what we did when we come up out of 2009. And I found some other recessions, same story. The dollar started moving down a few years after pulling out of recession. And that should support the U.S. economy, at least on our export side of goods and services, including commodities. So here I am. I reviewed the stock market model. I've reviewed the economy model, and it's just saying, leave it alone. Don't touch anything. And I like the forecast. I think we're seeing the evidence to back it up here. And it's, as always, it's going to be an interesting decade, but it's going to be a different decade than what we've seen in the past 40 years. I think just because I think interest rates are turning up on a super cycle where interest rates, I don't think they're going to scream higher by no means, but I think they can move higher over the next 15, 25 years. I think you've got a Federal Reserve changing their attitude, saying they're not going to be so scared of higher interest rates as long as inflation's up. But as long as that inflation is not necessarily just runaway commodity prices and runaway labor, it's just more of, hey, everybody's getting paid a little better. I don't think they're going to raise interest rates to kind of knock it down. They're going to give it more room than ever before. They don't want to upset the cart here. So we do have to be looking out for things that we've been trained for the last 20 or 40 years that is going to start swinging differently. Some of the old timers in commodities, if they're still around, they may be able to recall those days. And of course, those days were of more inflation and better commodities. So with that, yes, I'm bearish the dollar, bullish economy, bullish the stock market. So what about those commodities? Because we've gone through 7 years of eroding prices, best you could say, for like corn and wheat in 2016 put in a major business cycle bottom. And even though some people say, boy, it hasn't done much, well, really, wheat's behaved much differently than the prior 20 years. We're not seeing on the fund side the bears saying, well, you always sell wheat, do nothing but sell wheat. They don't do that anymore. They look at both sides. And, they always used to say, well, if I'm buying corn and soybeans, sell wheat. Well, they do that on a really short-term basis still, but it's not much. Something has changed the attitude there. And I'm not so sure I can explain that, but I can explain it in terms of the business cycles, in terms of production. It does make sense there to me. So here's what I feel on the soybean side. The soybeans did not put in that major business cycle back in 2016. We've had I shouldn't say way too much supply, but we've had more supply than demand, and it weighed on the soybean market to just cap it, not necessarily drive it lower, but it just took away the upside of soybeans. And that may have actually also taken away the upside for commodities in general, because everything's somewhat interrelated, okay? There's entanglement, even though there's also the microeconomics for each commodity, of course. But to me, the soybeans probably put in that major long-term business cycle this year, bottom, that is. And now we got all three grains on the same page. And so, and this helps to explain why we've seen strong prices since August. And fortunately, from my modeling, I told my subscribers in August, hey, we got to be long-term bullish, at least corn, probably wheat, and we better start thinking about soybeans, that this could be what we've been watching for a few years now. It's finally here. Well, then look at that trend into this December here, right straight up, basically.
Yeah.
And I think they're overreacting, dialing in too much of inflation. But the point is, it's there, it's on their table, it's on their desk, it's in their modeling, it's in their strategies. And I'm in full agreement with them. And then so what they're just saying, if we had that inflation, that makes prices more buoyant. It doesn't necessarily have to drive them up huge amounts like in the 1970s. That was more of a super cycle top, getting way, way out of hand. But you can have more buoyancy. Well, then add just your normal supply demand fluctuation, when suddenly things get tighter or you get a supply crunch from a crop problem, that even adds more fire to it. And that's backing up saying that, well, that's even yet another reason to own some commodities here. So I think they're getting excited that, hey, we just went through this recession and it was a terrible thing. A lot of people died. It was a totally different kind of recession we've ever seen. And I agree with some of these even billionaires like Ray Dalio. I follow Dalio, but I'm not so sure I've seen this specific forecast. But tonight there were people tweeting saying, well, Dalio believes we got a 1920 scenario coming here. For
the economy as a whole.
What's that?
Well, I mean, in the 1920s, the ag economy wasn't all that.
It wasn't all that good. It wasn't all that great. That's right.
Yeah.
You actually had, if I remember right, you had like cattle market was doing very well, where the grains were not. The grains had, and I think the grains peaked out in 1919, 1920 or something like that. Probably closer to 1918 pandemic, actually. So you were getting a split economy. It was still more of the Wall Street kind of thing in the 1920s, and the people working in service industries, but you were also building way too many factories and the latest technology. So it was trickling through, hiring people and paying them well, agriculture, not so well, right? So it was more of a technology thing in the 1920s. Yep. So we want to watch out for that. But this time around, though, with this kind of inflation, if you could put some crop problems in there, at least the agricultural community should get a few years out of this decade, a few years out of those 1920s, let's say that, that they get an explosive run. So when if commodities are only going to get a slice of, say, what's going to occur for the decade, a slice of this 1920 scenario people are throwing out there, when will that occur? And I think you need that crop problem on top. Yes, we're getting inflation. Yes, we're getting growing global economy now. The indicators are showing they've already pulled out of the recession for the world, that they had problems from 2018 to 2020, and a very abrupt turnaround, I must say, for the global economy, which is nice. So that's inspiring everybody. And there is something about when you have these kind of disasters like we've just gone through with the pandemic, people think differently when it's over. It's kind of like they're just glad to be alive, and it's like they're going to spend, they're going to enjoy life. So all of these things can trickle in. Again, I don't want to say that's what's going to drive, corn another $2 higher or anything like that. I think what it does mean is it's very unlikely you're going to see below 350 corn anytime soon. It's going to be buoyant. We're established some better floor prices. We kind of wash things out and panic things enough going into May to August here in the U.S. For our corn futures. So, but here on the modeling of weather, climate, crop yield, crop production, I'm coming up with what I've said for years now. We're due for a problem 2021 to 2024. And we got a La Nina that, I think it's impacting Argentina, but you can argue Argentina has some problems almost every year. But I think La Nina's could be making it worse. We don't know. Argentina takes them a very long time to plant and harvest. And so they're a very long growing season when you look at the whole country. It may take a while to wake up whether they truly have something serious. But the point is, when I look at it, at least Argentina, you can say, okay, there's a problem there. Brazil, you really can't say there's a problem there. I've seen pictures of some of the fields. I've seen some of the issues. It seems more of a corn and bean problem. But there's issues there. And there's still time, especially in the next 30 days here, that you could take a hit. And, it seems like people have been ratcheting that Brazil soybean production number aggressively higher. So sooner or later, somebody's got to be wrong.
Right. Yeah.
So, to me, we could still get some bullish stories coming out of there. And is the market dialing that in now? I don't know. Maybe there's something going on where somebody with the biggest amount of money and can really weigh on the market that they've got this all figured out. Yes, there is an issue there and nobody's seen enough yet, and it is coming. I don't think that's entirely the story. I think it's just a piece of the puzzle. And I think it's this whole inflation, money printing. Hey, it's time for commodities to come back. And commodities do better after recession. You get your economy back on track. And they're putting all these pieces together. And they're just saying, why wouldn't you buy commodities at these levels?
Yeah.
Now,
all right. Again, so I got a question about that, Rich. Okay. So let's talk about, so the January ending stock report's coming out here whatever, next 2 or 3 weeks, whenever it comes out. And they've had plenty of time, unlike past years, to really go in and check and see what that ending stock's going to look like. What was the actual harvest in the U.S.? What did that actually look like? So you got ending stocks report coming out in January. You got this harvest pressure, drought pressure down in Brazil and Argentina, corn and soybeans. I mean, what's your reaction to that? I mean, how do you think that's going to start playing into? Do you feel like there's I don't want to say use the word explosion because that's not what I'm looking for, but I mean, do you see $5 corn in 21? Do you see $5.50 corn in 21? I mean, what's your thoughts on that?
Yeah, that's the tricky thing because I can't tell, is 21 really our crop problem year? If we rule out the U.S. and just look at where we are now, at this level, I think there is a chance to see $5 by summer in 2021. I wouldn't be surprised we're going to try to get it there before summer, and then it's going to be a real problem that don't get the crop problem. It comes down during summer while you're still trying to gamble. Do we have a problem or don't we? Right. So we want to be looking out for early tops. I don't know what to expect out of the January report because they focused so much, especially back in September, saying, gosh, they really should not show us a record yield in corn. And I got that right. Okay. They didn't do it. Now the problem is, I don't know how I'll think if, they put it back up to a record yield. I don't think they're going to do it. If anything, I think it comes lower, frankly.
Right. Agreed.
So, and here's the interesting thing with the corn model. It's really saying, and this is the kind of things we discuss for our subscribers here. But the model right at the moment, it was saying, okay, you got a chance for available demand to back off in December. Available supply is going to remain tight right through the end of the year. But that demand can bring grains down. Well, we got a little blip here and there. Nothing really happened. Next thing we know, we're going up. And then the model's just firing off red alert signals saying, wow, that available demand's back. It's stronger than anticipated. You still got the available supply. You got to get bulled up again. Here we go again. So fortunately, 2 weeks ago, warned higher prices. Then a week ago, I said, wow, here's some new upside targets for you in soybeans. Look out. And well, it has met those objectives, but you know what? I got still higher objectives generated tonight that I'll be informing subscribers of tomorrow. The model suggesting that really the grain prices should stay up into late January, early February. And the interesting thing is that's the way it is for a lot of commodities. I'm kind of surprised how many commodities have evolved in just the last 2 or 3 weeks to come up with the same forecast. That warns me, yes, probably you're getting that commercial side saying, you know what, maybe it is time for better margins, better prices. Maybe it is time to put things up. We're going to get through this recession. But more importantly, it's probably on the future side would be the funds who are also dialing in that. Now, here's the point. You use this for reverse modeling. If the grain markets are going to remain firm into late January, that's a warning we are probably not going to get a bearish January report. And even if it's bearish, for some strange reason, it's not going to last. It's not going to make much of an impact. And if anything, it, of course, leaves the door open for a bullish. So to me, I'm more confident right today in making the price forecast that we can have stronger prices in late January than I am forecasted what will go off that January report. But that's encouraging me to then say, you know what? USDA is probably going to be in line with what the model's saying. They're not going to throw something bad at us to break that trend. Will I be right? I don't know, but I've gone through this 10,000 times in 30 years, and all I can tell you is I got confident enough to just keep going with it. That's right. The best I can do, right? So to me, I want to be optimistic here for the start of the year in commodities, and it'll be very interesting because there's old timers out there who say, hey, if you can get a strong January in the stock market and some of these commodity markets, that can be a sign of the environment for the year. Don't know how well that really works, but I got to tell you, it's always discussed year after year. So right. I'll keep an eye on it as well. So here's how I look at it. To me, the grains they're in a minor long-term business cycle that will not top out to summer. And I mean, that cycle's up. So what that tells us is be on the lookout for more bullish fundamentals or supply and demand picture. And at the very least, of course, rising prices or at least firm, stable prices. You don't go down to your historical lows for some reason. Then look at your seasonal trend. Normally, things like corn and soybeans bottom out the first week of October. They'll head higher into summer. Now, when I say normal, that's just an average. And you can dig deeper and find out it really doesn't work as often as you'd like to see. Well, when you see that, just go ahead and compare it to the actual fundamentals and look at our S&Ds. Everything's tightened up in the last 3 months. That says if there's any truth to a seasonal, it should work this time around, okay? It should show that average performance, and that average performance is up until about June. So that's warning us that we really ought to err on the side of looking for bullish fundamentals to continue for a while here. Yes, we've already dialed in quite a few of what we've seen here. Yes, I think the grains are a little ahead of themselves on the inflation story. But the point is, it's really how I'm balancing everything out is it's a warning. Let's keep looking for that next bullish story, something different to add to it. Okay. And then, of course, when we get into summer, we have to ask that $1 billion question of, are we going to get a great crop? It's going down to harvest or not, right?
Right.
But right today, I'm sure the feed user has been hurt here. And if they paid my attention to my signal in August, they should have had some stuff bought ahead. I'm sure uncomfortable for them, but hey, that's the way the pendulum swings. Right at the moment, the sell side is in bit of control of things here right now.
Okay, so one other thing I'll touch on as we've watched commodity prices go up. Excuse me, as we watch commodity prices go up in value over the last 30 to 60 days. The oil market's done the exact same thing. I mean, it was banging around that $39 to $42 range, and now we're almost up to right now we're at $48.26 a barrel. We're knocking on that $50 a barrel phase, which is that really brings back in a lot of U.S. production, from fracking and those kind of things. So oil shale and those kind of things. What's your thoughts on oil and how is that going to affect the economy in 21?
Yeah, I don't think it can hurt the. Well, I suppose I should be a little cautious. In my opinion, normally oil will not hurt the economy till it's $80. But let's face it, we're just pulling out of a recession now.
Right.
So I still think you got to at least get it over $60 to hurt the economy. It's more of a gut feeling than scientific analysis, but that's what I'll go with. So I'm not too concerned. I'm pleased it finally went over $44. I said, gee whiz, I got to get it over $44, and then this thing should move still higher from there. And we've got it. The model here again, it's rather bizarre how crude oil kind of shifted in line with the grains. I'm seeing things like sugar, coffee, cocoa, cotton, especially cotton.
Yep.
They're shifting more in line with the grains. And I'm saying, oh my gosh, is everybody doing the same thing? That's just bizarre. But I've seen this several times over 30 years, actually. But it's still always kind of an amazing thing to see that you get them all in line. And they're all showing that commodities should do fairly well into late January. I will say heating oil can top out ahead of gasoline by a little bit. That's more of a seasonal thing, not too bit of a concern here. And I must say, the forecast right at the moment from the model is that even if there's some selling late January and February in crude oil, gasoline, heating oil, I think I think it'll be a minor thing because at least on the gasoline side, it should still be higher in March, April. That can support ethanol. And last week I told subscribers, hey, we got to watch out here. It's time for a bottom. Well, I kind of fell asleep at the wheel, and tonight I was looking at the chart. I thought, holy smokes, it popped last week, right by the end of the week. That might have something to do with some chart rollover. I'll have to double check, but it looks like we got a bottom in ethanol. Now, I'm not convinced ethanol can be a major driver of corn, or at least I haven't been for some time. But see, you get these bull markets going, and it's like, okay, we followed this piece of evidence or news or whatever it is. Now we need something new. Well, it's amazing how that something shows up. They may want to refocus and say, you know what, ethanol is doing pretty good price-wise. That is helping out. They can bid higher, I wouldn't get too excited over that, but it does look like ethanol can be supported here, kind of drag its feet at least with, say, gasoline and crude oil. So again, I'm still bullish a little bit here for a few weeks. And crude oil, I do think there'll be a setback, but I think we're going to see higher later. And I think most of the commodities in Wall Street stock market, they're looking at crude oil as more of an economic indicator more than anything. And I don't know. I think it's going to have to get over $60 before they say, okay, you're hurting the consumer and we haven't got this economy going that good, Right. But right today, I would not be concerned of that. If anything, I think Wall Street's saying, well, we'd like to see a little firmer crude oil prices here that suggest there's some optimism that there's some money flowing, that they can get better margins. That may well be a sign, yes, the economy is coming back.
So do you think as the economy opens up more with now we got the vaccinations that are available and those kind of things, and more people are more confident to maybe go out and take that summer vacation or maybe take that spring break trip or something like that? Do you feel like that oil could have a higher demand and we could see something get up in the mid to high 50s?
Yeah, I do. Boy, on the travel side, I'm already, from some of my sources, hearing that some bookings are improving. People are getting optimistic. They're going to want to get out there and do something this summer. So right today, from what I understand, yes, they don't think the demand that's being projected for summertime gasoline demand is as good as they want. But the market for the moment is saying, I'm okay with it. I got a feeling the analysts are going to have to ratchet up gasoline demand a bit. I don't have a number for you. I don't know how much. I just think it's going to improve somewhat. And
right.
again, it has to do with this psychological thing with when you have a disaster, something like a pandemic, and people have cabin fever. They want to get out and do something. And unless this virus, for some strange reason, is just really super strong this summer, I think we're going to have a good summer economy. So,
right on, man. Well, hey, Rich, good stuff as usual. A lot of great information there. Anything else you want to make sure people know about before we shut down the podcast for the night?
No, there's nothing on I'm just waiting to wrap up the year, and hopefully, like I say, I'll be warning my subscribers sometime going into late January, February on some signals here for all these markets, commodities, and stock market. But overall, I think we're on track for what we're looking for 2021, and that's a reason to be optimistic prices at the moment. Right
on. Okay. Rich, where's the best place for folks to listen to your podcast and subscribe to what you're doing?
Go to criticalpointpodbean.com.
Criticalpointpodbean.com.
Correct. And Podbean is the host, and then Critical Point is my page, and you'll see a list of all the podcasts, and you click on those, and if they're not free, you'll see a little subscriber thing to sign up. And on the subscription side, we talk about the economy and all the crops and major commodities. And, of course, the stock market. I give a variety of signals from short-term to all the way all to the long-term. And, by the way, I want to make a little announcement. I almost forgot this. For 2021, I've been asked by followers, subscribers to maybe manage a few accounts in the stock market for them. And I've been in discussion with a company to help set this up. And so anybody's interested, want me to manage the money for them, they need to contact me at rich@ag-financial.com. And by the way, you can use that email if you have a question about my podcast or the markets. But that's something I think I'm going to expand into for 2021.
That's great, man. You can use some of those charts and stuff that you've got there, and a lot of your models and stuff that have been proven to really be winners there.
That's right. That's right.
That's good stuff. Well, that's great, Rich. Well, I appreciate you being on the podcast, and I will talk to you next year, man.
Very good.
All right. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find the latest editions of the Moving Iron Podcast as they come out. Also, check out my website, MovingIronLLC.com, and you can find all the great information about Moving Iron Summit and everything else that has to do with Moving Iron Podcast as well. The Moving Iron Summit has been postponed from the January 20th through 22nd time frame that we had scheduled there. It's been moved to September 15th through the 17th. Same hotel, same information. If you have any questions or want to get more information about that, go to MovingIronLLC.com and click on the Moving Iron Summit tab, and it'll get you the information there. Or you can shoot me an email at MovingIronPodcast@MovingIronPodcast.com. So until next time, I'm Casey Seymour with Rich Posson. Let's go move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. moving on.